The trade war between the U.S. and China is escalating, but many investors may be caught off guard by one of the possible outcomes, according to Bank of America Merrill Lynch. President Donald Trump upped the ante on Monday when he instructed the U.S. Trade Representative to impose a tariff on $200 billion worth of Chinese goods. The latest tariffs, along with previous rounds on $50 billion of imports, meant that over half of all Chinese goods coming into the U.S. would be subject to the duties. China hit back the following day, announcing tariffs on $60 billion worth of U.S. goods. Investors are disproportionately expecting the dispute to worsen, versus a trade deal that resolves the situation, according to James Barty, the head of Global Cross-Asset and Emerging Market Strategy at Bank of America Merrill Lynch. There's proof of this bias in how much better U.S. risk assets are performing versus emerging markets. In a recent note, Barty pointed out that non-U.S. equities were underperforming U.S. stocks by the most since the financial crisis. Sure, some of the weakness in emerging markets has stemmed from country-specific issues like the currency crisis in Turkey. Some of it also has to do with rising U.S. interest rates, a stronger dollar, and a firm economy that's supporting earnings growth. However, the initial rally of Asian and emerging market stocks after Trump escalated the trade war on Monday demonstrated how much of the news had already been priced in, Barty said. Meanwhile, Larry Kudlow, Trump's top economic advisor, has said the door has opened for talks with China. And with the Trump administration eyeing the midterm elections and a second presidential term, it may not want to disrupt the economy's progress. This leaves investors in a quandary because should there be talks and a turnaround leading to a trade deal, as in NAFTA, EU, US, then with the Chinese already stimulating their economy and the US continuing to grow rapidly, the prospects for a decent year of growth in 2019 would look pretty good, Barty said in a client note on Friday. In that situation, given where sentiment and positioning are, you could see a big rally in cyclical assets. Such a rally would challenge the majority view, according to Bank of America's survey of fund managers, that emerging market risk is higher than normal. Bank of America Merrill Lynch: these investors are putting their money where their mouth is. The chart below shows that compared to other major asset groups, fund managers have the smallest positions in emerging markets relative to history. Bank of America Merrill Lynch: Barty is not oblivious to why investors are cautious and to the damage a full-blown trade war would do. A Chinese economic slowdown, or even just fears of one, could spook global risk assets, as happened early in 2016. Also, the Federal Reserve has flagged the downside risks of a trade war and could focus on them more if tariffs intensify. Barty's team added to its positions over the summer, but also maintained hedges just in case. We feel we cannot own risk without protection given the trade tensions, Barty said. Accordingly, we continue to run put spreads in SPX, UKX and EEM. We also have an AUD, JPY put. We keep our long SX5E, NKY, RTY versus SPX VAR as non-US markets are more vulnerable to trade-driven sell-off. The dispute is already widely being called a trade war, which brings into question what Barty is referring to as a full-blown situation. According to Kate Warren, an investment strategist at Edward Jones, a trade war becomes full-blown when each country's objective is not sending a signal or retaliation, but actually trying to restrict trade. For a trade war, you really need both sides saying what we want is higher tariffs and to stop this trade, and that's when you get the escalation, Warren told Business Insider. That's where you get countries hurting themselves for the benefit of less trade.